Okay.
All right. All right, guys, we're so glad you're here today. Thank you for attending the June 2025 State of the Market. And I'm excited today because I get to welcome my co-host to this call, Chris. Chris, do you want to introduce yourself a little bit?
And Brian, thank you. And I'm so excited to be here. I love the data and I love how data focused you are. You always have information, you got data some way, shape, or form. And I'm just happy to be able to be on this call with you today to contribute and give back. So everybody on this call, my name is Chris Cavazos. I've met a lot of you. If I haven't met you, I looked to meet you. I can't wait to meet you. Finance manager here at Echelon Home Loans Loan Officer. And I'm excited to give some data. I'm excited to do your loans. I'm excited to be a part of KW Coastal Living. And I'm excited to be on these calls with you guys to share information about mortgage related things and then also data related things, the same as Brian. Brian and I are very similar in our data centric mindset. We like to go out and find stuff and we share information constantly. And I love that we get to go back and forth for that because the benefit to that is we're able to give that to you as well. So happy to be here. Thank you for having me on this call. And I look forward to the future calls as well.
Yeah, Chris and I are like two schoolgirls texting in the back of the class on economic stuff. So here you've got our information. Of course, the purpose of this call is to be able to equip you with the understanding of what's happening in the market, to be able to better position your business to adapt to the changes that are in the market. And I think we can all agree there's been a lot of changes this last couple of years, really. And then lastly, it's to give you the tools to work with your sellers and your buyers to effectively move them forward in their purchasing and in their sales data. So this month we've got a whole bunch of data and we've got some scripts and some talk tracks for you to be able to work with. So as we lead into today's call, I'm going to say it's kind of an unusual month in that it's quieter than the last several months have been. There's still a lot going on, and yet it's a little quieter, which is kind of nice for a change. So, Chris, I'm gonna drive on this, but do you want to give us a mortgage product update real quick?
Yeah, great. And thank you for giving me the time. So the mortgage product update that I'd like to bring to you guys today is buy downs, right? I want to go over what buy downs are, how to explain what they do, so that you can use them and hopefully compete with the builders out there, right? So what are builders doing? They're offering these crazy incentives to offer not only buy downs or lower rates, but they're also offering seller concessions and all those types of things. And what's interesting right now is we've got a ton of inventory out there. So the builders are actually not performing as well as they should be because of all the inventory that we have in resale capabilities. So if we could act like a builder in some capacity, if we can act like that in a way to not only get more your listing sold, but then also offer incentives for your buyers to get in the door, that's what we're going to do. So today, I just want to talk about rate buy downs real quick and go over what they mean, how they function, and maybe you can use that in your sales process. And again, if you have any questions, you could drop it in the chat. If there's something that we need to take offline, more than happy to shoot me a text if there's something that you're confused about, or an email or a call. This way I can answer it further. But I will give a kind of a high level overview here. And, if there's any nitty gritty, we can dive into that. So what is a 2-1-3-1, 3-2-1, 1-0 buy down? Well, basically what that is giving your client or the buyer a lower interest rate and a set amount and period. So if it's 3-2-1, it's 3% lower than the note rate the first year, 2% one, then note rate. If it's 2-1, it's 2% lower the first year, 1% lower the second, and then 1. So if you look at the slide that's on the screen right now, it's really important to understand something when you're doing any of these buy downs. And I'm also going to segue here for a second, but when you do any of these buy downs, it's important to note that the rate doesn't actually change for your client. So if the client comes in and they're wanting to do a buy down and the starting rate is, let's just say 7.125, that is the rate for the buy down, right? And I'll go into more details from that. So where do the funds come from? They come from the seller. They can come from everybody except for the buyer. So Mr. Realtor, Mrs. Realtor, if you want to contribute to that, you can. The lender, there are lender paid buy downs. And then, typically what it comes from is the seller. So the way that it works is if you have a given interest rate, and we're going to use a 2-1 for this example. If it's 7.125 using those numbers, first 2 years later, or the first year, it's 2% lower, right? So it's important to know that, because what's happening is we're saving money, right? So if we're looking at the screen that we have right here today, we're going to use a $500,000 purchase price, 5% down payment, and we're going to use that note rate at 7.125. And Brian, we can probably go to the next screen at that. We'll
There you
roll
go.
with this. Yeah. So I'll just roll off this. We're going to give two examples. I said 2-1, but we're going to start off with the 1-0 buy down. So what does it mean? It means that the client gets this lower monthly payment initially in their first year. Okay. Why is that beneficial? Well, it's beneficial because they're saving money. So in the scenario that I gave you here, if we were going to have a client that had a rate at 7.125 at that 5% down payment, you could see that their P&I would be $3,200 a month. And I know, I mean, it's hefty right now. But with a 1-0 buy down, their first year's payment would be $2,889. So you can see the savings monthly for year one is $311 per month. All right. Well, how do we get to that point? Well, the seller has to contribute, in this case, 0.8%, roughly 0.8% of the loan amount, seller concession, to an escrow account to be paid on the borrower's behalf. So if in this scenario, man, like think about a borrower, think about having a listing, right? Think about what the sellers or the builders are doing out there. They're saying, hey, listen, I can get you a really low monthly payment out the gate. How can I do that? Well, this is one of the ways they're doing that. Now, I said before, I'm going to segue. Not all builders are doing just buy downs. There's another scenario that builders can take advantage of. It's called forward commitments. That does not apply to anything that we do, that you and I will be doing in this conversation. That only applies to large builders, like Lennar, like a DR Horton. And basically what they do in a forward commitment is they're able to do buy down a rate sheet. And I'm not going to try to confuse it too much. I probably already have. But the buy down scenario is something that we do have access to. And some builders are using this and leveraging it in the same way that you can, right? And so, you know, if you go to your client and you say, hey, listen, if I can get you a lower monthly payment for the first year of $311, who's going to say no? Right? I don't think anybody. And if you go to your seller and you say, listen, your house hasn't been moving, maybe we can offer a 1% seller concession, and then, you know, put some marketing materials in there to maybe make this listing seem more lucrative or more attractive, we can do so. So in a 1-0 buy down scenario, your first year, you would have your lower monthly payment. And then in year two, it would go back up to that $3,200 monthly payment. And I guess some of the pushback you might give me is like, okay, well, you know, that's still a 7.125 rate, right? So like, why is a buy down important right now? Well, we're in a times of uncertainty. We understand that interest rates are going to be cut. We know that the Fed is projecting to cut interest rates. In fact, I think they just mentioned that they're supposed to do, or maybe it was Chase that did some kind of analysis on it, saying that they're going to cut like 7 times next year. That's dramatic, right? Whether that's true or not, all things are pointing towards the Fed cutting interest rates and rates going down. So you might say, yeah, it might go back up to 7.125 after this year, but we're positioning these clients to say that, you know, even if you had a 6.125 rate, if it went below 6%, you'd probably refinance, right? Right. So that's the foresight here, is like, let's take advantage of the time that we have in the situation that we're in right now to get savings to your clients. Let's get the hook in to the listings to be able to offer these incentives, just like a builder.
Well, Chris, and I think especially if someone's coming from a renting situation, you know, there's renters tend to look at rent being the same as a mortgage payment, and you've got mortgage interest deductibility, you've got property tax deductibility. It's not the same, and this lets them ease into that payment without feeling like they jumped into the deep end, let the tax benefits kick in. We're not obviously tax accountants, and you know, the rent is not the same as a mortgage payment in terms of equivalent dollars.
It's great. And what's important here is that no matter what, your client is qualifying for the standard payment price, that's 7.125. They're not qualifying at the 5.125, or you see on your screen right now, 6.125. They have to qualify for the note rate. And why that's important is that they're not getting this super low payment, and then they're going to get some kind of payment shock and not be able to afford it. They may still get payment shock, because let's face it, people forget what's happening. And, you know, it's a good way to stay in contact with your clients. It's a good way to follow up with your clients if they're in these situations, to have that, you know, 36 touch or however you're setting up your follow-up plan. But they're qualifying at that higher monthly payment, so that we know that they can afford it, you know, at closing, right? And so the benefit is that they get to have this savings month over month over month. And so in this example that you see here, we're doing a 2-1 buy down, and essentially I'll answer that question for you in a second, Dean. Essentially, what's happening here is you could just see it, right? The first year it's 2% lower than the note rate. Year two, it's 1% lower than the note rate, right? And it's very important that you understand this and can explain it, because look at the savings. Year one, $613 a month. Year two, $311 a month. This is stuff to get exciting about, right? And then if we look below that, what's the cost to obtain a 2-1 buy down? 2.4% in seller concession. Now, typically, if I was you, I would ask for the 3%. Why? Because you can cover your buy down, you can cover some of the closing costs. Maybe you can take that 7,125 and you start at 7% instead and apply it in that kind of fashion. And at the end of the day, it's just giving your clients a better opportunity. It's giving you a leverage piece, and it's something that you can put in your marketing. Let's go ahead and go to that next screen, Brian. Yeah.
There you go.
Yeah. So, buyer's agent, negotiate rate buy downs at purchase. Sellers often willing to give if they get, right? So I don't have to tell you guys, we have a ton of inventory on the market right now, historically higher than usual, right? And if we're out there trying to motivate or get our clients to get into a position to make offers, then we got to be able to go to the sellers and ask for some of these concessions. And I think we're going to get it. I think if most people on this call will agree with me that if we're going out there to make offers, we're either going to get a super low sales price or what they're asking and then a seller concession at some capacity or the mix of the two. So this is a great advantageous place for them, for your buyers to achieve a lower monthly payment, and then also, making the correct offers to get the offer that they need accepted. And for a selling agent, what a better way to compete with a builder who can offer this nice, attractive, low monthly payment. And you know what? You can too. It just has to be structured. It has to be structured accordingly. And Brian and I can help you with what that verbiage looks like. In fact, I think we may even have some of those down further, if I'm not mistaken, right? So let's go ahead and go to that next slide area. Perfect. So I love this. You don't have to wait for the Fed or the bond market. A rate buy down is a way to get a lower monthly payment right now and then potentially refinance later. So that's what I was mentioning before, right? So if the seller, let's talk about what this looks like holistically. If the seller is giving you some type of a credit, let's just say a 3% seller credit, we're doing a 2-1 buy down. All those funds that the buy down, let's actually go over this in a larger picture. When the seller gives a 3% seller credit, you guys will make an offer on your contract that says, seller to give buyer, seller and buyer agree to give 3% or a dollar amount of the purchase price towards the buyer's closing costs. And okay, that's how you make your offer. Once we get into play in the loans perspective, and we choose a buy down, right? We choose to use those funds from the seller to buy down. There'll actually be another disclosure that the seller has to sign, right? Because the seller has to agree now to take that credit or whatever the dollar amount is and place it into an escrow account, because that's what's happening. So we mentioned that, the note rate doesn't actually change. It doesn't. What's happening here is if we have a 7.125 rate and we're doing a 2-1 buy down, all of those funds that the seller contributed is sitting in an escrow account. And every month that the borrower makes a payment, that escrow account offsets the monthly payment to make it feel like that lower interest rate, right? And that's very important to understand because it's an offset. That's why it's not a lower rate. So in this first paragraph here, it says then potentially refinance later. So what happens if they refinance and they didn't use all that money that was in that escrow account? Brian, you got an answer for me? What happens?
You tell me.
All right. So if they got a leftover balance in that escrow account, it gets used as a principal reduction payment in their refinance. So they don't lose the money. The money still goes to them in some way, shape, or form if they refi before they're out of funds accordingly.
That's a great tip.
Great tip, right? So, I mean, the money's never lost and, it's going to come back to benefit them later in the form of a credit. And so that's why a 2-1 buy down is really, really lucrative, especially right now. Because we expect to see rates down in the lower sixes, hopefully by the end of next year, especially with all the rate cuts, maybe sooner. I mean, just depending on all this commentary that Brian and I will
we're going to talk about. Yeah, we're going to talk about.
We're going to dive into it, the craziness that's happening, right? So I love this point too. We're out here dropping sales prices. And, I understand that, a lot of the time, what do they say? Price is what sells a house, right? Obviously, if it's not moving, it's got to be for price or number of other reasons, right? But what's really interesting is that this is a statistic I want you guys to remember here, is that every $10,000 in mortgage Every $10,000 you put down on a mortgage really only impacts the mortgage payment by roughly $60, 50 to $60 per month, right? So when you're like, all right, I'm going to drop this payment or drop this price by $10,000 in a mortgage transaction, that's not super beneficial. In the same way, in a 2-1 buy down situation, a seller credit situation, we've just demonstrated that they can have a payment $600 lower their first year, $300 lower their second year than the note rate, right? And so when it comes to reduction in sales price, there's more cost benefit to them. You're leveraging that in a finance transaction that is, mind you, only financed. There's more cost benefit to leveraging that in other ways than rather than just knocking it down. So when you get to a place when you're talking with your sellers and it's like, hey, we got to do something, we got to move something, maybe before you take that $50,000 price cut, you offer a larger incentive, right? And that incentive is going to be structured to be able to offer a finance person, X, Y, and Z. And maybe you start there to see if you can drum up some business. I think I recently read a stat that in Sarasota, I think it's a 42% is what I saw. Cash market, I think is the number. I have to go back and double check. It's higher than it's less than what I used to think it was a 60% cash market. There's a lot of finance transactions happening here in Florida these days, right? So very good point to be able to you leverage this instead of a rate buy down. So that's all I got on rate buy downs, guys. I see Dean, you asked if buy downs were only for owner occupied. Yes. They're not going to be doing no 2-1, 3-2-1 buy downs on any kind of investment properties. It doesn't work that way, unfortunately.
Good question. All right. Thank you. If you guys have questions on rate buy downs, I'm going to tell you, I used rate buy downs extensively in the 2000 to 2006, 2007 era. And it's a great tool. And I encourage you guys, talk to your buyers about it, use it as a part of your negotiations toolbox, and you'll save them money and you'll capture their attention. It's something that's a point of difference. So, all right,
Totally.
Let's dive into what is happening this month. We've got Godzilla tariffs go to court. We've got 10-year treasuries that are falling, but they're still very sensitive to data that's happening in the marketplace. We're going to talk a little bit about interest rate spreads. Unfortunately, the spreads still remain higher than what we would like to see, which is keeping those interest rates higher. We did have the dot plot, and I know that that's kind of one of those technical geeky things that people like Chris and I look at, and yet it gives us some insights into what lies ahead. We've got some inflation data to share with you, some unemployment data, and then we're watching very closely the builder confidence. This continues to sag, and the tariffs are creating a little bit of a headwind on the builder market. And the funniest part about this whole thing is we had the nuclear bombing in Iran, which normally would have been like a market mover that would have shaken everything apart at the seams. And with so many other things happening, it was literally not even a blip on the radar. It was as if you had not watched what happened over the weekend on Monday morning, you would have thought nothing happened in the world. So I was happy to see that, and we'll kind of talk a little bit about that. So tariffs. Last month, if you missed the recording, we talked about why the tariffs are in place and what the massive trade deficit is that Trump is looking to close the gap on. Last month, literally while we were on this call, the Court of International Trade ruled that Trump had exceeded his authority and blocked the April 4th tariffs. These were not the across-the-board 10% tariffs. These were the industry-specific tariffs. The very next day, the appeals court stayed the lower court ruling and reinstated the tariffs, so they're back. And just a few days ago, June 20th, the Supreme Court said, hey, we're not going to expedite your hearing on this, so it's going to go through the standard appellate channels. This means that the tariffs are still in place, and it's probably going to take longer for that to work itself out in the courts than some parties had hoped. So the tariffs are still here. Talking points. I know that your consumers are asking, how is this affecting new construction? How is this affecting prices? So here's just some kind of talking points for you guys to have in your head. The tariff lawsuit timeline suggests it will be after summer before the legal challenges resolve, if category specific tariffs stay or if they go. meaning buyers may see continued volatility in new construction pricing. And we're seeing the builders are indicating that they're somewhere between about 9 and 16% increase in the cost of new construction based on the tariffs. This all makes resale listings much more appealing. So this is a great opportunity. New construction has had the upper hand for the last several years. And this is ironically kind of putting the shoe on the other foot. And this is actually benefit resale existing homes. So this is something to talk with your sellers about for sure. 10-year treasuries. The 10-year treasuries are falling, but they still are very sensitive to inflation and jobs report. And in fact, things have been trading in that 4.3 to 4.5 range, which is kind of that 4.2 is kind of a key technical level. So if we take a look at the 10-year treasury, 10-year treasuries do a slow dance with interest rates. And I've got a screen that'll show you this here in a moment. But you can kind of see how sensitive the bond market has been to the little bit stronger jobs market that came out June 6th, and then the inflation report that came out in June 16th. And yet you can kind of see it's continuing to taper down. And that's part of the reason that we continue to see interest rates tapering down. Chris, what were rates, 30-year fixed rates running today, ballpark?
They're at like 6.7 average, down from, I think it was a year ago, it was like around 7%. So the average today is 6.77.
All right, good. Okay. So here's the good news. Rates are easing after a recent 4-month high, which if you kind of put that on the positive tilt, we're at a 4-week low for interest rates running in that 6.7 to 6.875 range, which is where Chris was seeing those today. Mortgage interest rate spreads. Spreads are the difference between the pricing in the bond market and what that 30-year fix actually becomes priced at. On average, your spreads have historically been 1.5 to 2%, and I believe the 20-year average is 1.7 or 170 basis points. So you can see here that June 19th, the average mortgage rate was 6.81, and the 10-year treasury was running at 4.386. The difference or the delta between that is what we call the spread, and that's 2.5%. That's an indicator that rates are still higher because the market is still pricing in volatility. It's pricing in the tariff, the unknown tariff issues. There's just a lot of things it's pricing in that they're hedging a little bit. So when we look at that, if we go back to June of 2023, that's when mortgage spreads were at the highest that we've seen in modern history here. They were nearly 3%. And when I say modern history, not back to the 80s, but in recent history. So at 3%, that's part of the reason that we saw those interest rates that hit almost 8%. So when we look at the slow dance between the 10-year treasury and the 30-year fixed rate, part of the reason we talk about this so much is our consumers, and sometimes even your agents in the industry, they think that the federal funds rate reduces, that with a reduction in the Fed rate will reduce interest rates. And if you remember the last reduction we had, the Fed cut rates 25 basis points and mortgage pricing actually went up because the market had priced in more than a 25 BIP price. It thought we were going to be at a half-point reduction. So the gray line represents the federal funds rate. The blue line is the 30-year fixed rate mortgage, and the red line is the 10-year treasury. And so when the stock market goes up, bonds go down, yields go up, things are inversely proportionate. And so it's important when we talk about Federal Reserve policy to understand that the 10-year treasury actually impacts 30-year fixed rates more than even what Fed policy does. So June 26 spreads are at a 2.5% average. In order to see that come down, we're going to have to see a couple of different things. The first thing would be just some softer economic data, some softening jobs data, some increased unemployment, some increased first-time claims for unemployment, something like that. Or the next thing that will probably could impact that is some tariff resolution. If we get some trade deals now, the big beautiful bill, as it's referred to, the spending bill, is working its way through Congress right now as we speak. I caught that Trump made a comment the other day that after the bill gets passed, that he would go back to tariff negotiations, and that we would probably expect to see some tariff resolutions in July. We have heard that before, so that could be the case. That could still be just positioning. But if deals come together, that could move rates down anywhere from about 50 basis points, 0.5% to maybe 0.75%, even without a Fed rate cut. The question is, is that going to happen? We've been looking at this for a while, and we keep thinking it was going to happen, and it just hasn't yet.
And that's a good point, Brian, if you will. What are the mortgage companies doing? They're afraid that they're going to lose their book of business, right? What is a mortgage company's business? It is to originate a loan and then sell that loan for a profit, right, on the secondary, or maybe retain it and then collect a mortgage payment for 30 years with that interest. So mortgage companies have to really are impacting these spreads significantly right now because they're worried about refinance, prepayment. Right. If I do a mortgage, just so you guys know, if I originate a mortgage right now, I have a chargeback period, meaning if I do a close on a loan for a client and they don't make 6 payments, not 6 months, 6 normal monthly mortgage payments, that chargeback comes back to the loan officer because it's called an EPO, early payoff. Right. And so what are all these lenders doing right now? They're really scared that they're going to lose all this business and that they're going to get refied out of. So they're hedging. That's part of the reason why spreads are higher right now, because they're trying to get their money on the front end because they know on the back end they might lose it. So and that has to tie into, it directly ties into the uncertainty that Brian's talking about.
Yeah, that's great. Yeah. So if you need a little talking point, rates are likely to fall, but let's find a house right now while you have negotiating power. If rates drop later, you'll be in a great position to refi. And if you wait, you may be competing with 5 buyers instead of being the only one writing an offer. For a seller, more available inventory to choose from, coupled with this week's decline in mortgage rates, could be the spark that gets buyers to the table, gets them off the sidelines. So there's some talking points. As an agent, with where we are today and the prediction that rates will be lower by the end of the year, I would say start to prepare your buyer pipelines now with your lender partners. Think echelon. Have approval letters ready before rates shift. You want to have that process done because sometimes the rates go down and pop back up, and you want to be able to take advantage of it and be ahead of the market. This is a great time to re-engage cold leads who had pumped the brakes. I know that we've got a huge pipeline of people that just said, I'm just going to wait till affordability gets better. This is also a great time to help sellers prep their listings now to go active once rates drop, because we will see a lot of buyer activity picking up. So if they've got cold feet about entering the market, use that script. And then consider rate buy down strategies now to preempt competitive rate improvements later. Okay. So turn a buyer into now buyers. So we talked about this a little bit. Fed funds rate changes are correlation, not causation. So when you hear Jerome Powell talk about cutting the federal funds overnight rate, that has an indirect relationship with mortgage rates. And it's only about 60 to 65% of the 30-year fixed rate movement is the 10-year treasury. The other 30 to 45% is actually the federal funds rate. So June, the Fed meeting in June was a lively one. Powell held the federal funds rate steady for the 4th consecutive time in a row. So we've had 4 non-movements. He emphasized a wait and see approach, holding off on cuts until tariff effects on inflation became clearer, and indicated maybe September was a time frame that he would revisit this. Now, there is a tremendous amount of pressure being put on Powell from the Trump administration and Trump appointees to get rates lower. The housing market is a substantial part of the economy, and the fact that we've been in a recession in housing for 4 calendar years, really 3 years straight, it's the rest of the economy is doing great. We're hurting. It's been a tough couple of years. And so Trump wants to get the economy spurred in that segment to get rates down and get them moving. So we're watching this kind of brouhaha between the administration and Jerome Powell start to kind of brew at the next level. They did hint at some form of rate cuts in 2025, but it was contingent on future data. And we're going to talk a little bit about what some of the other Fed governors thought. Powell went on to warn that tariffs could create persistent inflation, not just a one-time bump. And the Fed has two goals. They want to maintain consistent employment and they want to maintain consistent inflation. Inflation has come down, but employment hasn't really started to break. We're still, I mean, it's the U.S. economy is resilient, for lack of a better way of saying it. Inflation's been in that 2.4 to 2.6% range. Yet Powell said he maintained a somebody has to pay for the tariffs mentality. He indicated the economy is in a solid position with strong job growth. Unemployment is around 4.2% and balanced I can't even say it today. Balanced participation. But here's the thing that he added, and this was the little cherry on the top that really threw the Trump administration over the edge. He said, while finding a job is challenging for workers, the Fed is not planning to cut rates anytime soon due to uncertainty, particularly around tariffs that could rekindle inflation. So they actually are saying, hey, we realize the job market is getting tougher, and the Fed did indicate that it was going to be labor over labor over inflation a couple of statements ago, but he's dug in. He's not moving. So what happened? Well, it kind of exploded. Trump immediately called for the Fed to cut 2.5%, a crazy amount. That would be a market mover probably that we wouldn't even want, to be candid. Bill Pulte piled on and called for Powell to resign, and immediately the Fed governor, Michelle Baumann, came out and contradicted Powell and said that she believed that rate cuts should begin in July. And this starts kind of this conversation that we've been talking about for a few months about what it would look like to have a shadow Fed or a shadow Fed policy. That concept means that even though Jerome Powell's term does not expire until next year, someone that is tapped to be his replacement could start to share, here's where I think things are going to go. And that would move the bond market in advance of the Fed actually making the cuts. And that just kind of cuts Jerome off a little bit at the knees. So it's going to be interesting to see how this plays out. The next 30 days will be very, very interesting and telling. It could be that Baumann or Waller could be Trump's nominee to replace them, and that would potentially bring interest rates down. And if we can just get things a little bit closer to that 6% range, the market will take off. We have anywhere from 1.2 to 1.7 million transactions the last 3 calendar years that should have happened that haven't, and those buyers they're out there. So let's talk about
point, Ryan. Yeah, that's a great point real quick, Ryan. Yeah. The shadow Fed president thing right now, I think they're calling for two cuts this year. I think that's what's on the deck. And, with all this, verbiage out there, all this talk about maybe cutting next month, if that does in fact happen, it'll be a significant market mover, because right now, every mortgage industry is pricing in a cut in September. That's where we're at. They're saying, all right, we got this. So if something happens next month, it is going to be a shaker and mover, because now this was unprepared. You'll see bond market rally in the sense of go down, and it could move rates significantly if that does come to fruition. So I'm championing for it, of course, right? We want to be able to have the lowest rates for our clients, be able to, get some deals done. And back to your point, Brian, statistically, they're queuing us up that if once we get to 6%, there's going to be 4 million refis available to unlock, right? That's just refinance business. So what about the purchase business that comes alongside that too?
Yeah, that's an entire year's, not a great year, but that's an entire year's worth of transactions, all just in the refi market. So
correct.
Yeah, well, so to that point, the commentary signaled that the Fed may cut rates 2 times, which would be about 50 basis points in 2025. When we look at the dot plot, which I'll show you next, we had 8 Fed officials that said, hey, we've got 2 cuts that should be happening this year. 2 thought that we should cut 3 times. That was their speculation. 2 said 1 cut, and yet 7 said no rate cuts at all this year. So you can see there's a lot of discontent happening even within the Fed as to what should happen to continue to move forward. Now, this is the dot plot, and each quarter, each Fed governor goes in and says, hey, here's where I think things are going to be. And we don't know who is who on this. You have to kind of read the tea leaves. But this indicates, you can kind of see the box there shows that a large number of the Fed personnel believe that we would see 2 rate cuts of 25 basis points by the end of the year. Now, in 2026, it indicated that on average, they thought that there would be another 25 basis point cut, which I was surprised. I expected to see that come down a little bit more next year. I think 2026 is turning out to be probably a banner year for real estate, to be candid. We're setting up for a really great run ahead. And then 2027, you can kind of see where they think that those rates are going to go. We would be moving from the 4.25 to 4.5 down to 3.25 to 3.5 by 2027. So brighter days ahead. It'll just be interesting to see which of these really kind of affect Powell and what he does. It's going to be no one knows where we're going. So we just take a quick look at inflation. Inflation rates have improved, and this is of course a key condition for rate cuts to happen. Cooling inflation means better rate environment. And again, the big Godzilla tariffs are the wild card on what to expect. We take a look at where we're sitting today. We're sitting May numbers, headline numbers, we're showing 2.4% inflation. 2% is the target, although I'd almost argue that we're probably 2 to 2.5%, maybe more of that common number that we'll see going forward. Now, we're pretty stable. And when you compare this to the 5-year historical number, of course, in 2022, we were told that the inflation was going to be transitory and it was going to be short-lived, and it held on far longer than we wanted it to, just like COVID. So you can see we've really come down, and this puts into perspective where we are in terms of the pace of growth of cost of goods. Unemployment also steady. Again, the economy is doing pretty darn well. We're sitting at about 4.2% in that May report, and the June numbers, it matched expectations. There just weren't a lot of surprises. And as I said, the Fed has indicated they're really watching that labor market. So if we see that creep up to 4.4, which was the Fed's target this year, or 4.5% unemployment, that's when you'll see the Fed be a little more apt to want to be a little more accommodative and drop those rates, or at least get to a neutral state. This is that unemployment trend for the last year. So you can see not a lot's changed. We're pretty 4% is pretty much full employment. Everyone that can work has a job at that point. If we compare that back to that 5-year that takes us back into COVID, you see where that super high unemployment was sitting, and that was part of the reason that we had so much economic stimulus and other things that really brought a lot of money into the marketplace. Talking about home builders, I've been watching this closely. Home builders are a little bit of the canary in the coal mine in terms of when their sentiment drops, they pull back on construction, and that means construction workers, as new builds get completed, construction workers start to lose their jobs. That's been a leading indicator of a recession in each of the last several recessions. So home builder sentiment fell to 32 in June of 2025, down from 47 in January. That is very, very low. The report shows economic uncertainty from tariffs, elevated rates, and elevated building material costs have depressed how the builder looks at the future. I thought this was really interesting. The builders reported that buyer traffic in their properties are down to November of 2023 levels. So traffic is down, and the impact of the tariffs is, again, that 9 to 10 up to 15% increase in construction costs. So it's, construction's taking the hit of the tariffs. If we look back historically, this is the 5-year trend of what that home builder sentiment looked like coming out of COVID. You can see sentiment shot up, and then of course during the period when we saw one of the highest increase or one of the fastest increase in federal funds rates. And of course, interest rates shot up to almost 8%. Confidence surged. It's been up and down, a lot of seasonality, but they're feeling the pinch, definitely. So it's a good opportunity to either negotiate great pricing with builders right now. Additional concessions usually is what they're willing to do as opposed to price reductions. But even locally, it's softer than what they would like to be.
Yeah, let me just add real quick, Brian.
Sure.
You know, Lennar in Q4 reported profit margins of 22%, right? And in Q1, they got down to 19%, which was like the lowest Q1 margin in a decade. And so while, you know, we see a lot of influx of people heading to these new construction places to buy these homes, they are hurting. The new builders are hurting the same way. And I have friends in the industry, in the new build industry, as I'm sure you guys do too. And if you talk to them, sometimes they'll tell you like, listen, nobody came to our new construction thing. You know, you hear, it just depends on where the price point is essentially, right? If it's an affordable home, obviously it's going to get more traffic than the like, because that's what people need right now, but they're not in any better position than they were either. So they're feeling all the same pains similarly than you guys are.
Yeah, I think that's very apropos, and that's a great statistic. I'll keep this one a little more milk and cookies, but SLR is just it's a Frank Dodd era rule that calculated how a bank's assets could be deployed and what could not be deployed. And this was a Trump policy through Scott Bissett to really attempt to bring rates down through policy as opposed through the Fed. And it's going to allow banks to buy more 10-year notes and would lead to reduced rates. So we're watching this closely. It's a very, very technical banking aspect, but it did move forward. It was approved 5-2 by the Fed Reserve, and we're in the commentary period currently, and I believe that runs through August, if I remember correctly. So we would probably see that come into place somewhere later this year. So again, that would be a fall or maybe Q3, early Q4 type of a timing. But again, this will bring money out of banks' reserves into the 10-year Treasury market. That will bring rates down. So we're watching that very closely.
And Brian, that happened, you know, that's happening right now. Like as we speak, that's happening. And the fact that it was proposed, even the proposal itself impacted the bond market today. All right.
Correct.
So it's so delicate, the things that are happening. It's like the right word that's said, the right text that goes out, the right post that happens is impacting the bond market. That's how sensitive. And I really want to bring light to that, because that creates the uncertainty and why spreads are the way they are, why they're hovering so high, and also why Powell's like, what's going on? I don't want to do anything. Maybe that's an argument point right there, just because of all the uncertainty surrounding it.
Yeah, that's great, and that could be why the Iran bombings happened on the weekend when markets were closed, because it didn't send just a jolt through the market. Yeah. It had an opportunity for us to get to Sunday. They retaliated, one and done. It was over, and now here we go.
Yeah.
So existing home sales, we're still sitting at just over a 4 million pace. It's the fourth calendar year of the lowest sales pace in U.S. history. It's on par with 1995, but when you account for the 72 million population growth that we've had just through legal population growth since 1995, we're sitting at the lowest sales pace in U.S. history. And so, again, I say this often, if it feels hard right now, it's because it is. It's actually statistically never been harder to sell real estate than what we're in currently. So push through, stay in the market, do the right things, and you're going to set yourself up for a wild success over this next 5 to 7 year cycle that we're getting ready for. So you can see we were I believe it was 4.02 million was our seasonally adjusted pace. We typically don't see less than 4 million home sales in any given year. That's the floor and just the minimum sales pace that we would expect. If we look back over history and we go back to 1995, you can kind of see the wild run up of over 7 million home sales in that run up to the 2008 market. And then of course the bounce again in that COVID era. You can see we've gone backwards. So it's tough. All of this, I show this consistently because I think this is one of the most important things to talk to your clients about. All this what we really have is we've got an affordability issue when we look at the fact that appreciation and inflation has outpaced wage growth in this last 5-year period. High interest rates mixed with that just creates an affordability issue. And in the last 5 years, and I need to update this because this was a January statistic, but the last 5 years, the average appreciation of US homes was 41%, while the average wage growth, real wage growth, was 14%. Coupled with high rates, you can just feel what that means. And when we put this into this slide, this was from the National Association of Realtors, the principal and interest needed to qualify in 2001 for a median home price was $1,206. Before taxes and insurance in 2024, in October of 2024, it was $2,086. So it's a 72% increase in the monthly payment, and it took a 46% increase in income just to qualify. So you can see where that rate sensitivity is just keeping a damper on the market. Okay.
I got something for you too on that. And,
Sure.
and talking about affordability and appreciation, can you go back one more screen for me?
Sure. Yeah.
If we look at that statistic, look, average price US homes in the last 5 years, the last 5 years are an anomaly, right? We had COVID happen. We had things happen that really drove up prices that normally wouldn't have happened. I'm going to give you a Florida statistic real quick. From the year 2000 to December 2023, that's where my data line ends on this. The average appreciation in Florida was 6% year over year, including what happened in the downturn of 2008. So even in those negative years, it still averages out to be about 6% in our Florida market year over year over year. Right now, if we go down to our local, hyper local Sarasota market, we're in a bubble. We're in a completely different space. But it's important to know that when you're having that talking point that, like, listen, we had some downturns, but we're still on a positive appreciation level year over year over year over year over year. Right. And that's something you could also convey to your clients as you're buying houses. Like, listen, even with downturns, Florida statistically has had a decent appreciation level year over year. I mean, COVID was a banger. We had like 30% appreciation over that time. Total fluke, right? Total fluke. Don't expect that to happen in the near term. At least I don't hope. I hope that doesn't happen.
I hope not.
I hope it happens for my own house, but only my house, right? Because let them all stay down, because it just, affordability will really be out the window there. So.
Yeah, that's good. Okay,
Yeah.
so let's take a peek, and I'm going to go through these numbers a little bit fast so that I can catch a little bit of the local data here at the end. Let me just move this out of my way here. There we go. All right, national. Nationally, of course, inventory is still a little bit more restricted, although we've got a really key level that we just hit this month that takes us back to 2019 levels. Median list price in the U.S. is 464,000. Median days on the market, average is 102, median is 56, and currently single family resales, there are 828,000 single family properties on the market. And if we contrast this with last month, let me just go forward. US inventory actually grew by 5.3% last month. So inventory is growing. Now, when we look at the condominium market, the median list price of a condo in the US is 389,000. We're still in the slight seller advantage across the United States. And I realize that US markets and Florida markets and Sarasota are different. That's why we break these down individually. Nationally, the average days on the market's running about 4 months, 123 days. And we're going to go into this a little bit closer, but there's currently 232,000 condos for sale. Now, this data comes to you from Altos. Every data source measures numbers, listing data a little bit differently. Altos tracks every listing available for sale every day in every market in the US. And they strip out new construction that can't actually be bought and closed on sometime in the very near future. I believe it's 30 or 60 days is their metric. So this is real available inventory, not speculation or any of those other listings that would be in there. That's where it differs a little bit from NAR data. And this is much more up to date and accurate in my opinion. So if we look at this, condo inventory in the US grew by 1% last month. So inventory is rising, but it is the first time that I'll show this, it's the first time since 2019 that the condo and the single family inventory has exceeded 1 million. And when you look at this was the single family housing market, June 2025. March 24th, 2022, we hit that low inventory of 240,000 homes in the entire United States for sale, resale properties. Historically, we would see 1.2 to 1.4 million, and you can see where that was just such an unhealthy, as Logan, one of the economists we watch, a savagely unhealthy market. Today, we're sitting at 828,000, and the story, I think the story behind the story on this is that this inventory growth is positioning us for a much healthier, much happier market ahead. So inventory growth is a good thing at this level. When we look at average days on the market across the US, you can kind of see we're sitting at 102, and we're up from that low in 2022 of 54 days. So we're getting back to a more traditional, healthier, more robust market. When we look at price decreases, this is an interesting one. Long-term average, you see about 1 out of 3 homes taking a price reduction at any given point. Currently, we're sitting in the US, 40% of homes have taken a price reduction, up from the crazy low of 16.6%. So we're a little bit higher than average, no question on that. When we look at properties relisting coming back on the market, we're starting to see that trending downward. We currently have 9% of the inventories are relist. And as we go through the year, as you guys know, people tend to take it off. They tend to wait for next year. They wait for rates to change, so on and so forth. So we're seeing that number drop. Median list price, this breaks it out into 4 tranches so that you can kind of see what the bottom 25% to the upper, but the bottom 25% nationally is 225,000, pretty affordable price. The upper 25% median list price in the US is 1.2 million. If we bring this down into Florida, we just say, okay, how are we doing in Florida? Across the entire state, it's still a little bit in the seller's advantage. We're looking at a median list price of right at $500,000. The average days on the market across Florida is 125 days, so very similar to the US numbers. Price decreases, I'm going to show that here in a second. And there's currently 106,000 single family, non-condo, single family resales on the market in Florida. When we look at what's happened, we've been seeing the last several months, we've been seeing some high single and some low double digit increases in inventory. This is the first month that pace of inventory has subsided. So we were at 0.4% of increase month over month. We went from 105,900 to 106,600 in the residential market. When we look at that median list price, we're at $500,000. Average days on the market, 125. Properties with price decreases 48%. So across Florida, 1 out of every 2 has taken a price reduction. And if we flip over to the condo market, you're going to see that median list price has fallen. 349 is the average, the median list price. We are in buyer's territory now in the condo market, as anyone that spends any time in that market knows all too well. Average days on the market is climbing higher, 161 days. So that is starting to get out there a little bit. So that's a number to really make sure you're talking to your clients about. 42% have taken a price decrease, and currently there are about 73,000 total condos on the market. If we take a look at this, median rents are staying pretty steady across the Florida market. Really, we just have a story of a lot of inventory and some price reductions. So if we take a look at this in terms of the totality, if we add all of the single family plus condo inventory in the Florida market, we've got 179,577 active inventory. We take a look at that same number in the US. The United States has just over 1 million total inventory, which, by the way, this is the first time we've seen this number since 2019. That means Florida currently has 16.9% of all US inventory. And interestingly, I don't have the numbers in here. Texas is almost the same number. So you've got 2 states with nearly 30% of all the inventory in the United States happening in it. So now that number is down from last month. So as our pace of inventory growth has slowed, we're starting to get into a little bit better percentage, but we just have our inventory outpaces the United States. Let's look through the local markets. Charlotte County, we're going to start there. We are still in a slight buyer's advantage in Charlotte County. The median list price, 424.9. We take a look at condos. We're in pretty deep buyer territory in the condo market. The median list price in Charlotte County is 278.5. We look at inventory. Inventory continues to grow. Again, this is not a bad thing per se. It does give buyers more options, and it sets us up for a much more healthier housing market on the other side. Roughly about 80% of home buyers bring a home to the market. So that means when rates drop, we start to see people selling, moving up. You're going to see more inventory growth even while as the sales base grows. But Charlotte County, it was the low was June 11th, 2021 at 282 homes for sale in the entire county. That's a crazy statistic. Average days, yeah, isn't that crazy?
Yeah.
Average days on the market, we're sitting at 150 in Charlotte County, up from that all-time low of 39 in 2022. Median list price. I've got some data right at the end of this to kind of tell you what's really happening with pricing. And I sat and crunched a lot of numbers and used my good friend ChatGPT to check my work. And it's interesting. So the sky is not falling. That's the story I want to share with you that the numbers tell. But median list price is softening, 424.9. We break the Charlotte County single family market into tranches. Your bottom 25 percentiles in that 275 range. You still have some affordable properties that can be bought. Your upper end in Charlotte County is running that 799 in terms of median list price. Properties with price decreases, I broke this down into the different tranches, and you'll notice that the trends are pretty consistent. Your top end, 1 out of 2 is taking a price reduction, and your bottom end is 6 out of 10 or 3 out of 5. So a lot of price reductions happening out there, and I'll speak to what that means and the interpretation that I see in the data here at the very end. We pop up to Sarasota County. We are very much in this says single family advantage buyer, but we're actually pretty balanced. 30 is pretty balanced between seller and buyer. Median list price in Sarasota County, 549. Average days on the market, 133. And 55% of homes in Sarasota County have taken a price reduction in the last 30 days. That's a big number. If we look at the condo markets, median list price of the condo in Sarasota, 399. We are in slight buyer advantage territory in that market. 130 average days on the market, so a little higher average days on the market, and 48% price decreases. We look at the inventory trends. The low was March 4th, 2022 of 328 homes for sale. We're currently at just under 4,000. So
Wow.
little more than 10 times the lows that we saw in COVID. Days on the market, I said 133, up from that low of 37. So days on the market, it's important to be realistic on the timing with your clients. The median list price, 549, down from that high of 699,000 in 2022. And if we break this down, the bottom 25 percentile median list price is running 325 in Sarasota County, and the top end is 1.7 million. Properties with price decreases, we're sitting at 55%. You'll notice that trend line is continuing to trend upwards, although it does look like maybe it's tapering out a little bit. So it'll be interesting to see what the next 30 to 60 days brings with us. And of course, we're up from the low of 13% of homes having taken a price reduction in 2022. Breaks it out in the tranches. You can notice that the lower end is the bottom tier, about 3 out of 5. Again, they've taken a price reduction. And the upper end is 1 out of 2. So very similar to Charlotte County. And if we go down to Manatee County, the median list price, Manatee County, 599.9, so almost 600,000. We're pretty balanced, again, between it being a buyer's market and a seller's markets, and 113 days on the market's average, actually a little less than the national statistics. And yet 56% of homes have taken a price decrease. And again, these are just single family resales. So these are existing homes, not new construction. I know that I heard a statistic on the call the other day that it was 14% of homes had taken price reductions, and that that took into account new construction, and that's where that number can be a little bit skewed if you don't take the new construction out. Condo market in Manatee County, 314, 220 median list price, average days on the market, 136, and 53% have taken a price reduction. You can see that that inventory continues to grow from the 2022 lows of 268 homes for sale. Average days on the market does continue to grow also. So again, it's important to talk with your sellers about the importance of proper pricing. Median list price is down from the all-time high of 857,000 in 2022. In Manatee County, you can see the price trend is following Sarasota. We're starting to peak a little bit on the number of price reductions, and we're still more than 1 out of 2 have taken a price reduction. So sellers are having to get realistic about pricing. Properties with price decreases, this breaks it down into the tranches. This is a good one just to print out and put in your listing presentation for each county that you work, so you've got this. So let's talk about kind of what does this all mean, and let's look at our local tri-county and give a little bit of interpretation for this. I showed this slide last month. This was the average sold price to list price comparison. And the story that this told was that if a seller prices their home right, on average, it was selling in 24 days. So this sense that it takes forever to sell a home, the data doesn't support that. It just takes a long time to sell a home if you miss the mark on pricing. So this is where your skills as an agent, in pricing the home, in positioning the home, making sure the home looks good. This is where you earn your salt. So if we didn't take a price reduction 24 days and it sold for 95%, if you did have to take more than one price reduction, it was 120 days and it was 94. It was basically the same reduction. However, Wayne Diller last month had asked for what was the statistic on final sold price to original list price, and it was about 84.5%. So you technically were accepting a lower price and having to sit on the market a lot longer. That's a lot of showings. You vacuumed and put the kids in the car and drove to Dairy Queen to get ice cream and all that stuff that you have to do to sell. So the importance of pricing. All of this leads to this question of, are prices really falling? So are prices coming down, or is the market just adjusting? And this is the question that I ask every single month. Say, are we going backwards? Are we losing core values, or are we just getting more realistic? And this is the data. So this is local data. So this is actually data pulled from the MLS, not Altos. But the local MLS shows that median list price year over year, and that's this month over last year, median prices are down 11.4%, and the average price is down 12.8%. Price per square foot is trending lower. One begets the other. And the sale price to original price, if they take price reductions this month compared to last month, was 84.2%. So that's an interesting statistic. It'll sell fast, and for 5% off if you price it right. If you don't, it's going to take a lot longer and you're going to sell for a lot less. When we looked at the sales price ratios, if the homes that took no price change, so they got the pricing right, this month was 55 days on the market, and it sold at 95.1% of original or of sales price. Homes with price reductions were 84.2 and took 103 days, and that's just this month's data. So our talk tracks on that is overpricing leads to a longer time on the market and larger discounts for the buyers. So an agent tip, just pricing it correctly will protect a seller's value and drive a faster sale, meaning you get paid faster. If we look at supply, month supply of inventory, which is a measure of if there was no inventory coming on at our current sales pace, how long would it take for us to sell everything that's on the market? Month supply of inventory increased from 6.4 months to 6 to 6.4 months. So it was up 6.7%. The market is tilting towards neutral and into a little bit of buyer territory. That means buyers still have time and leverage, but sellers do face more competition. And so this is where, when you're talking with your clients, leverage urgency with the seller. So whatever that urgency is, whatever their the reason that they're selling, use that as a lever to get them to price it appropriately. And then with buyers, the selling point, even with a higher interest rate environment, is the opportunity to take advantage of larger negotiations. If we look at supply and demand year over year, active listings, including new construction in this, is 9.6% year over year. Homes under contract fell 5.9%. So there's more inventory, less sales. Listings are going faster than pending sales, and that does tend to indicate a softening market, but not a declining market. That's an important distinction. So advise sellers on realistic timing expectations and buyers on negotiation leverage. And that's where what Chris was sharing on buy downs, that's where that comes in. Per square foot trends, one begets the other, I said. So the per square foot values are declining in line with median price drops. And when we looked at that data, it indicates that we have true repricing of like kind inventory. It's not just that certain inventory is moving off the market. We're seeing the pricing follow suit across all four tranches of the inventory, all four quartiles. That means more negotiation in inventory means better per square foot pricing for your buyers. Now, I'm not a big fan of per square foot pricing. I think it's like the number of tires on your car. You probably all have four, and yet someone may drive a Yugo and someone may drive a Maserati. But it is a trend that we do watch. So what does this all mean? It means that we are seeing a price reset in our Tri-County area, not a pricing crash. And I know that there's a lot of doomers out there. They're saying, oh my God, prices are just like they're falling like a rock. Well, homes are priced more realistically, and we're not seeing in the data that we're analyzing, and there was a whole lot of input that went into this. We're not seeing across the Tri-County area a loss of core valuation. Things are softer, but we're not like declining precipitously. Affordability ceilings have curbed that unrealistic appreciation. The sellers that thought, hey, we're going to go up 10% every year, 15% every year. Now we might be 1 or 2% this year at the end of the year. But buyer demand is still present. They're just more rate sensitive. So those are the important things. So a couple talking points. You're no longer buying at the peak. Prices are more reasonable and inventory is plentiful. You now have more choices and more negotiation power. So even with higher rates, if you qualify, it's a very good time to buy, because when rates drop, you may go back to multiple offers, multiple competing offers versus being just one buyer of a home. And the market's a lot healthier and balanced. It's a smart time to buy if you're ready. Seller talking points. This is a return to realistic pricing, not a market collapse. And homes that are priced right sell faster. Price too high and you lose time and money. And buyers are very financing aware. So we must price for today's market and consider financing incentives. Closing costs paid, rate buy downs, 2-1 buy downs, all those are great talking points. So that's where we are. Overall, it's a good time to, as I said, really batten down the hatches with those pipelines. Go back to the people you've talked to over the last couple of years, re-engage those conversations, because those are people that as those rates start to fall, they'll enter the market, and you want to be positioned to be in front of them as they enter the market. So that's where we are. We'll watch this very closely over the next 30 days to see where things go. As always, if you guys have questions, topics that you want us to cover on these calls, we're always happy to, and I will send out the copy of the slides with the copy of this recording. And I actually have a little bit of bonus content this month that I will send you out also that relates to the Tri-County area. I'll include that in the email. So before we, I know we kept you a little longer. Any questions, concerns, curiosities, excitements that you guys want to share? Wayne, I see your hand up.
Great information, Brian, and also Chris, good job. Brian, when I look at this days on market for single family homes, man, it's a different story. It's really it's a seller's market actually in Manatee at 4.6, and it's neutral, but Charlotte's been floating around between 6.5 and 7. So when I look at single family homes, which is some of us specialize in, it's a different story on that work month supply.
Yeah, and so that's a great point, and that's the MSI incorporates MLS data, including new construction. So if you're looking at resale only, that does impact, but that's really good statistic to know. So you said you're running Sarasota County at 4.2.
Okay. I've got this
Ballpark.
week, Manatee's running anywhere from a 3.9 to a 4.2 for the last 4 weeks. And then
Wow.
Charlotte's the other end has been running anywhere from a 6.8 to a 6.5. Still
Yeah. That's
somewhat neutral, but balanced market. But definitely the Manatee. But that's offset by how
that's
much discounting. You're right on. The discount rates are running around 13 to 15% from original list to sell. So you can certainly there's bargains to be had out there if you negotiate it right.
Yep.
yeah, that's great. Thank you for that, Wayne. Appreciate you tracking the data like that. Awesome. Okay, Kennedy, any other questions in the chat? Let's see.
Nope, we are good to go.
All right.
I got two more things before we slide off here.
Sure.
Number one, hey, on July 9th, I'm reading this right now. The Trump's 90-day tariff pause ends on July 9th. So this is going to be a talking point for you and your customers, right? To bring that back up. And what happens is that when that happens, if no deals are made, now you're going to have trade wars again, right? And how is that going to impact our market? And another thing I want to talk about too, real quick, is we were talking about spreads, mortgage spreads at the beginning of this conversation. If they were normal today, we'd be at a 5.97% 30-year fixed interest rate if we had normal spreads. And that's
Wow.
without changing that's with no cuts. So you can just, what that tells me is the uncertainty surrounding the mortgage industry and what's going to happen next is why the mortgage companies are keeping their rates higher collectively, because at the end of the day, they're a business for profit, not to lose money. So that's just some really interesting news to see and some foresight to understand that spreads really do make a difference in pricing.
Great point. Thank you, Chris. Appreciate that. All right, guys, we will give you your day back. We appreciate you. Go do what you do best, serve your clients, and make some deals happen.
Thanks,
Thank
y'all.
you.